This method is different than what a lot of investors are used to doing. So it's fairly unique, and I would say in a certain sense it's almost like the secret approach that not a lot of people know. So definitely stay tuned. I think you're going to really appreciate this method of evaluating companies. So what we're going to do in this method is we're going to be looking at how Google is able to reinvest the money that it makes, and how that will then determine the return that's available to us as investors. So it's basically, we're breaking down Google into basically two parts as an investment. The first part is the cash return that's available to us as investors. So the cash return that's available is comprised of two parts: the dividend and the share buybacks. So we got our cash return, which is our dividend and our share buybacks. And then in addition to that, we got our growth return, which is based on the company's ability to reinvest its earnings. So if I go to Word, I can write that down, very simple for you. So we got two components. One is our cash return, and our cash return is equal to our dividend yield, dividend yield, and our share buyback yield. By the way, these two together are known as the net common payout yield, right? So we got our cash return, which is our dividend yield, and our share buyback yield. And we have our growth return. A growth return being the company's ability to reinvest earnings. So the combination of our cash return and our growth return will give us our growth rate as investors, or rather our return rate as investors. So what we're looking to see is, if we buy Google today, what is the likely annualized rate of return that we can expect over the next, let's say, 10 years? And so the first thing that we need to look at is our cash return, which is our dividend yield and our share buyback yield. As most people know, Google does not pay out a dividend, meaning its dividend yield is going to be zero. And we can see that here. If we go to Yahoo Finance, dividend is not applicable because Google does not pay out a dividend. So we know that our dividend yield here is going to be 0%. The next number that we have to look at is our share buyback yield. What is the yield that we can expect from Google in terms of them buying back their shares? Over the last 5 years or so, Google has bought back about 4% of their shares per year. And I can show you how you can look at that. If we go to Y charts and we look at share buyback yield, or just simply buyback yield rather, we can see that Google is buying back about 5% of their shares recently, and the historical average has been about 2%. But, we can expect, based on this trajectory, that Google is anticipating to continue to buy back their shares at this price. Or rather at this rate. So if Google's buying back their shares at about 5% per year, we can add 5% in terms of our share buyback yield. And now the final thing that we really have to calculate is what our growth return is going to be. In order to calculate our growth return, we're going to need a couple of different numbers, but it's fairly easy to do. In terms of our growth return, what we're really looking at is the company's return on invested capital divided by the weighted average cost of capital for a company like Google. And this will give us what's called a reinvestment factor, or a growth factor. So I'll show you what I mean. So if we look at Google, their return on invested capital can be found just simply by typing in return on invested capital, or if you want to use this free resource here, which is ROIC.ai, which is an AI-powered free sort of stock database. You can look at return on invested capital and see what Google has been able to return on its invested capital over the last 4 or 5 years. I use Y charts because it just gives me the average right away. And we can see that Google's averaged about a 19.4% return on its invested capital. So if we go back to this website here, so 19.4% is the return on invested capital, which is essentially what that means is the money that Google has, it reinvests it into the company. This is what it's able to return in terms of a yield on that money. So for every $100 that it reinvests, it gets $19.4 back in addition. So we need to divide that by the weighted average cost of capital. For a company like Google, there's many different ways to calculate it, but it's about 9% for Google. So we'll just type in 9%. And by doing that, what we get is this reinvestment factor or growth factor. So we can take our return on invested capital, 19.4, and divide that by our weighted average cost of capital of 9%, and we get a reinvestment factor of about 2.2. So this could be called growth factor. So let's review. We got our cash return, and we have our growth return. Our cash return is our dividend yield, which in Google's case is 0%, and our share buyback yield, 5%. So we can say the cash return for Google is 5%. Meaning the company is going to pay us back as owners in the form of dividends and share buybacks of about 5% per year. In addition to that, we have our growth return, which is the company's ability to reinvest earnings and grow. We've calculated that by taking a return on invested capital and dividing it by our weighted average cost of capital, which gives us a growth factor of 2.2. Now what we need to do is take this growth factor and multiply it by Google's retained earnings. So what we can look at is if we go to, in fact, yeah, we can go to this free website here and look at what their net income is or their net profit, and we see here it's $67 billion per year over the trailing 12 months, and Google reinvests 100% of it back into the company because they don't pay out any dividends. So we can take this number here, $67 billion, and we'll go back here. So let's put the amount, the net income is 67 billion. And we're going to multiply that by the growth factor. Now remember, the growth factor we calculated by taking the return on invested capital and dividing it by the weighted average cost of capital to give us this growth factor of 2.2. Now we're going to take this 2.2 and multiply it by our reinvested earnings. So 2.2 times 67 gives us a number of $147 billion. So we can write down 147 billion. Now, taking this 147 billion, what we're going to do is we're going to divide it by the enterprise value of the company. The enterprise value being the market capitalization of the company plus the debt minus the cash. So what we can do is we can look here for Google's. We can look at Google's enterprise value here, which is 1.03 trillion, which is a big number. So we'll go down another line, 147 billion. Divided by 1.03 trillion. And that'll give us a percentage figure, which is our growth return. So let's do that there. 147 billion divided by 1,030, which is 1 trillion and 30 billion. And that gives us a growth return of 14%. So let's review this growth return. In fact, let's just go through this entire thing one more time. So our cash return is 5%. What our cash return is our dividend yield plus our share buyback yield. So dividend yield plus share buyback yield. So that's 5% cash return. In addition to this cash return, we're getting a growth return of 14%. The way that we calculate this growth return is we take our return on invested capital and divide it by our weighted average cost of capital. This gives us a growth factor. So our return on invested capital is 19.4%. We divide it by our weighted average cost of capital of 9%. Very simple to calculate your weighted average cost of capital. Just Google Google's weighted average cost of capital. There's a lot of calculators out there. I didn't look it up, but I guarantee you it's going to be around 9%. So we take our 19.4 divided by our 9% weighted average cost of capital, and that gives us this growth factor here of 2.2, because 19.4 divided by 9 gives us about 2.2, right? So do that again. 19.4 divided by 9 gives us about 2.2. So that's our growth factor, 2.2. Now we take the company's retained earnings, which is basically their net income times their retention rate. In Google's case, it's 100% since they're not paying any dividends. And we get this number here of 147 billion. We take the 147 billion and divide it by the enterprise value. So we took this 67 billion retained earnings multiplied by our growth factor, which was determined by this ratio. And we get this number here. We divide that by our enterprise value of 1.03 trillion, as you found right here, 1.03 trillion. And that then gives us our rate of return on growth. So we take it here at 19.4%, or sorry, we take 147 billion, divide that by our 1 trillion 30 billion, and we get a return of about 14%. Now, what we have to do is we have to add our cash return to this growth return, 14 plus 5, and that gives us a return of about 19% per year. Meaning, if we buy Google now at this current price, what we can expect is an annualized rate of return of about 19%. Meaning, like it's going to compound annually at 19%. That's what this number means. So this is sort of the secret way of calculating if something's a good investment or not. This is the method used by a lot of great investors. It's not really talked about. You have to really dig deep to find all this sort of information, but I'm putting it out there for free. It's also what's taught at the Columbia School of Business in that sort of master's degree program that Warren Buffett took for value investing, founded by Benjamin Graham. And not a lot of people know this. And so that's why I'm putting it out here for free. I hope I explained it well enough for you. Again, essentially what you're trying to do is you're trying to add your cash return to this growth return to determine a total rate of return on your investment annualized. So what this is saying is that if we buy Google at this current price, what we can expect is a 19% annualized rate of return. There are some additional things that we got to now take into account, such as what's called the franchise fade rate, which is determining what rate we can expect Google's franchise to erode at. But we're not going to look at that in this video. It's a little bit more complicated, and I don't want to add unnecessary complexity to this. So I hope this explained to you a way of calculating your rate of return that's different than sort of what most investors out there do, quite frankly, because they probably don't know about this method. And now that it's out there, I hope that more and more people start to use it because it is a really beautiful way of looking at investments. I hope you found this video informative. Please like and subscribe, and take care.